Good morning everyone. Today we will be taking a closer look at the financial performance of two major players in Sri Lanka's retail and food sectors, which are Keel's Food Product PLC and Cargill Ceylon PLC. As you can see in this slide, this presentation aims to provide a detailed evaluation of both companies, focusing on key financial indicators and trends. By comparing the performance, we aim to deliver clear and actionable insights that will support informed decision making, not only for investors but also for the stakeholders with interested in the Sri Lankan consumer goods industry. This introduction sets the stage for a deeper dive into the financial health, operational strategies and market positioning. Let's move ahead to explore how these companies are shaping up to today's competitive environment.
I would like to talk about the importance of comparative analysis. Comparative analysis involves evaluating a company's performance by comparing key financial metrics such as revenue, profit, cost, and cash flow against industry peers. Benchmarking performance helps businesses measure their position in the market and identify where they stand relative to competitors. Additionally, comparative analysis plays a vital role in identifying strengths and weaknesses. Companies can uncover their competitive advantages by analyzing financial data across multiple entities. Furthermore, it enables informed decision making. Investors and management can leverage comparative insights to make strategic choices, ensuring that resources are allocated effectively and investments are well justified. Lastly, comparative analysis fosters a culture of continuous improvement. By regularly assessing financial performance and adapting to market changes, companies can maintain their competitive edge and stay aligned with evolving industry standards.
Then, I'll be introducing key financial ratios that form the foundation of our comparative analysis. Financial ratios are essential tools that help assess a company's performance and health across several dimensions. In our analysis, we categorize them into four main groups. First, profitability ratios. These measures a company's ability to generate earnings relative to revenue, assets or equity. They help us understand how efficiently the company turns sales into profit. Next, liquidity ratios. These reflect the company's capacity to meet its short-term obligations. A strong liquidity position is vital for maintaining smooth operations and financial stability. Then we have efficiency ratios, which evaluate how well the company uses its assets and manages its liabilities. These ratios give insights into operational performance and asset utilization. Finally, solvency ratios, also known as gearing ratios, assess long-term financial stability by analyzing the company's debt levels in relation to equity and assets. Together, these ratios provide a comprehensive picture of financial health and guide us in making meaningful comparison between companies.
My topic is profitability analysis. Keel's Food Product PLC has a higher gross profit margin than Cargill's, 21.39% versus 11.15%, showing better control over production cost. However, Cargill's outperformed Keel's overall profitability. Cargill's recorded a positive net profit margin, return on assets and return on equity, while Keel's reported negative result in all three areas. This indicated that although Keel's managed production cost well, Cargill's is financially strong and profitable overall. Thank you.
I am presenting about liquidity analysis. Liquidity analysis shows how easily a company can pay its short-term debts using its current assets, things like cash, receivables, and inventory. If these assets are greater than the short-term debts, the company is in a safer financial position. Let's take a look at the liquidity position of both companies. Starting with Keels has a current ratio of 1.13. That means it has just enough current assets to pay off its short-term debts. But the quick ratio is only 0.64, which means if we remove inventory, Keels might struggle a bit with immediate payments. Then moving to Cargill's, it has a current ratio of 0.71 and the quick ratio of 0.45. These are both below 1. It means Cargill's doesn't have enough liquid assets to meet short-term debts. This could be risky, especially the company runs into urgent expenses or delays in selling inventory. In overall, Keels is in a stronger liquidity position than Cargill's. It has more flexibility to handle short-term money needs. Thank you.
I'm going to explain the efficiency ratio analysis. We looked at three main ratios. First, inventory turnover ratio. This shows how quickly a company sells its inventory. Cargill's has a ratio of 6.50 times. Keels has 3.25 times. This means Cargill sells its inventory faster. They are better at turning stock into sales quickly. Second, receivable turnover ratio. It tells how fast the company collects money from the customer. Cargill's 14.26 times, Keels 5.99 times. This means Cargill's collect customer payment faster. They are more efficient in managing credit and cash flows. Third, assets turnover ratio. This measures how well the company uses its assets to make revenue. Cargill's 1.25 times, Keels 1.03 times. This means Cargill is using its assets more effectively to generate income. They are getting better returns from their total assets. In summary, Cargill perform better in all three ratios. This shows that Cargill is more efficient in managing its resources than Keels. Thank you.
Hello everyone, my name is Praveen. According to this presentation, my topic is solvency analysis. Firstly, I defined what is the solvency analysis. Solvency analysis is the process of evaluating a company's ability to meet its long-term financial obligation. So according to this, we can see some key areas in the solvency analysis. They are debt of equity ratio, interest coverage ratio, debt ratio, and net assets per share. Next, let's see how these key areas affected to the Keels Food Production PLC and Cargill's PLC. Firstly, how they calculate debt to equity ratio. Debt to equity ratio equals total liability divided by total equity. So Keels Production PLC shows moderate debt to equity ratio. It's 1.13, and Cargill show high leverage debt to equity ratio. It is 3.67. Second, equity ratio. Its calculate is equals to total equity divided by total assets. Then so Keels show strong equity ratio. It is 47%, and Cargill show low equity ratio. It is 21%. Nextly, interest coverage ratio. It's equal to operation profit divided by financial cost. Keels show minus 0.9 and Cargill show 2.04. Finally, debt ratio. It's equals to total liability divided by total assets. So Keels Production PLC shows balanced debt ratio. It is 0.53, and Cargill show high leverage debt ratio. It is 0.79. So my part is over. Thank you.
Thank you, Pramit. Now I am going to explain about comparison of Cargill's and Keels based on 5 key financial areas. First one is revenue. Cargill's recorded a strong, that is 4.94% year-on-year growth, while Keels saw a 16% decline. Second one is profitability. Cargill's remained profitable Kales reported losses. Third one is expense. Cargill's managed its cost efficiently. Kales, however, experienced a sharp increase in expenses. Fourth one is liquidity. Cargill's maintained healthy cash flow, but Kales is facing liquidity challenges. And finally, shareholder value. Cargill's continues to deliver value to its shareholder, whereas Keel has seen a decline in shareholder value. Therefore, we can say Cargill show strong overall financial health while Keel is under significant pressure across multiple fronts.
Today I want to talk about how two big food companies are doing. Keel's Food Product PLC and Cargill's PLC. Let's start with Keel's. The company has had a true time. Their income and profit have gone down. One main reason is that their costs like bills and running expenses have gone up. This shows that Keel's is having money problems and may need to change their plan and how they run the business. Now let's look at Cargill's. Even though they also had higher cost, Cargill's was able to grow their income and make more profit. This means they are managing their business well and working efficiently, even in the difficult time. In a summary, Cargill's is doing well and has good chances to grow more in the future. But Keel's is facing big problems and needs to think carefully about their next steps.
To conclude, our comprehensive financial analysis reveals a clear contrast between Keel's Food Products PLC and Cargill's PLC. While Cargill's demonstrates strong revenue growth, improved profitability, efficient cost management, and robust cash flow indicating sound financial health and promising growth potential, Keel's faces significant challenges with decline, revenue losses, rising cost, and liquidity stress. This underscores the need for Keel's to strategically reassess its operations and financial management to restore stability and shareholder value. Overall, this comparative analysis highlights the importance of continuous monitoring and strategic decision making to enhance financial performance and sustain competitive advantage in the market.